In this presentation, we will work a problem related to present value in Excel. The information will be up top. We'll use that information to populate the blue areas down below. We do recommend when setting up any Excel worksheet that you put the information, the data up top in the format of text, and then the numbers in a different cell so that we can then use those as a reference, that being the most efficient way to go through this process. We're going to do the present value of one calculation here. Remember that as you look at all these types of present values and even looking at the future values as well, they're all related and there's different kind of ways that we can go about this. We'll go through the common ways to do this. It's important to see that they're all kind of related, what these different ways are, and not to think about these different ways as if they're completely different things, different animals, different things that we have to deal with, because if you see the similarity, then you can say, oh yeah, I see what we're doing. It's all related to this one item. We're just taking a different approach to the calculation. Now, there's a couple different main approaches we'll have to the calculation. One is with a formula, which often might be used with the present value calculation. But then when we go to like annuities or when we're in practice, typically we don't often use the formula because we have other tools to use, typically Excel or a financial calculator, usually in practice, or most books will often give the practice of a table to be used. And the reason that's great for tests or school is because they can give a very simplified calculator that can't do too many type of financial calculations and still allow us not to have to memorize the formulas but use the tables instead. So the tables will be common in school, that will be using those. In practice, Excel will be the most common approach. And then some instructors, if they're not very nice, they might make you do the formula as well. Many accounting classes won't force you to do the formula, possibly the present value, but usually when we get to the annuity table, they'll generally let you do the tables, at least for most of the accounting type classes. But be aware that they're all the same thing. So if you see any of these approaches, we're just doing the same thing. You can verify the same thing different ways, and that's a good practice to do. And we'll do that practice here. So here's going to be our data up top. We have the periods 2. We're going to say 2 years are going to be the periods. Be aware that the periods could be something other than years. But if you do have periods other than years, then you've got to account for the fact that the interest rate has got to be in alignment to whatever the periods are. So that's one thing to be aware of. So we're going to do the 2 years. We're going to do the amount of the 242. The rate is going to be 10%. Now notice we're always going to have a rate when we look at these things, and we'll talk about the different, where do we get that rate? What does that rate come to? Note that you could think of it as a present value type of rate in terms of the time value of money, the interest rate possibly, or we'll think about it as the rate of the next best option. So basically opportunity cost driving the rate that we're going to have. Those are going to be two common ways that we'll think about this interest rate. It's going to be something that we'll have to determine when we're thinking about the present value type of calculation. We'll talk more about how to determine that rate, what are the factors to involve, and a future presentation. First, we'll use the tables here. So for the tables, we're just going to say, all right, the amount, I'm going to say this equals the amount. The amount is going to be the 242, and then we're just going to take the amount from the table, and we're going to use the table. Notice the interest percentages are up top. The periods are on this side. Remember, the hardest part about this is picking the correct table. Usually there will be 4 of them. 2 present value tables, 2 future value tables. You can eliminate the future value. We want to pull the information back to the present. So this is future information that we want to current value, one lump sum in the future, 2 years out, that we want to bring back to today's dollars. And therefore, of the 2 present value tables, it's going to be present value of 1, present value of an annuity. We want the present value of one number, present valued. You can also note that you'll have the right table if it's present value, and you can see the amounts are going to be less than 1, which would make sense because if we multiply this amount by something less than 1, we're going to come up with something less than the amount that we are present valuing, which makes sense because it must be smaller than the amount we're present valuing because the amount is sometime in the future. In today's dollars, it must be less. The annuity table will be greater than 1 because it'll involve multiple payments. So it's going to be something greater than 1. So we're going to have then the rate is going to be 10%. The periods are going to be 2 years. So we're going to go 10%, 2 years. We have the 0.8264. That's the one we want, 0.8264. So we're going to say, all right, 0.8264. Notice the formatting of Excel. I've added decimals so we can see the full point 8264. And then we're going to say the present value and just multiply those out to get the present value, which will be equal to the 242 times the 0.8264, that giving us 200. So 2 years out, the 242, if we present value it, is going to be multiplied times the 0.8264, and that will be 200. Now we can do that same calculation in Excel. We can do the same type of calculation in Excel using a present value formula. The present value formula is simply going to be, there's a couple ways we can do it. I'll do it this way first. We'll go to the data up top. The formulas up top, insert function, and we'll go to the present value. If you type in present value, then it'll search for what we want. I've got the caps lock on for some reason, and we'll go. And then we're looking for the present value calculation. It should be PV is the one we want. It's way down here for some reason. Present value, that's the one we're looking for. Here's the description of it. We're going to say, okay, that's the one we want. Now we've got the data field, which is a little bit easier than just entering the data in a formula setup, as we'll see the formula setup as well, which isn't bad either. I like using it. It's pretty quick to do. So we'll go, the rate is going to be our data up top, 10% in B4. So B4 has that 10%. Then we have the number of periods is going to be 2. In this case, 2 years. If we have periods other than years, we're going to have to basically adjust the rate to line up, of course, with the periods. So if it was per month, then the rate at 10% per year divided by 12, we'd have to divide it by 12 to get the monthly rate. And then we're going to say the payment, there is no payment. This is the tricky factor. There is no payment because payment would indicate an annuity. We're going to be using the same present value screen for both an annuity and a present value of 1. And the factor that will change between the two is us saying there's no payment amount, there's a future value amount, one amount in the future that we need to pull back to the present. So 0 on the payment, future value 242. You can see it'll give us the answer here of 200. It's a negative right now, so I'll keep that for now. We're going to say enter 200. Now, if we want to make that a positive, the way I would do it is I just double click on this item and say negative before the PV, and that'll flip the sign, basically saying, hey, multiply this times -1. Now you can see if you double click on this cell, this is the formula that we have. And it's equals, and I put a negative, PV, and then brackets B4. So B4 was our data up top, is the rate. And then we've got, and note here, we've got what it's telling us what we're going to do. So present value of the rate, which we picked up at B4, comma, that's just saying now we don't want to go to the next term, in PER, which is the number of periods, 2, so that's B2, comma, that's going to say, hey, go to the next term, and then the payment is 0, because it's not an annuity, and then the future value, we said, was 242, and I don't know why I typed it in there. It should be 242 from this cell, and then enter. So there's our 200. So let's go ahead and type that in this time. So I'm going to delete this. I'm going to type it in. Instead of equals, I'm going to say negative to flip the sign. Present value. Double click the present value. And then we'll go through this setup. It's going to say we want the rate first. We're going to say, all right, rate is 10%, B4. Scrolling back down. Then it says comma to go to the next term. There it is on the next term. Number of periods. We're going to say that's going to be 2 years in our case. Comma, then it goes to the next term, payment, we don't have one, 0, comma, and then the future value. So the future value is going to be that 242. And that'll be it. We'll close up the brackets, and that's going to be our present value type of formula. Next thing we'll do is run kind of a check on our numbers, and we'll run this backwards. We'll basically say, hey, what if we start with the 200 at the present, and then we were to add the interest for 2 time periods, and then come up to our number of the 242 at the end of 2 time periods. So let's just give a check in that format and give us some more insight into this type of calculation. So in other words, if we took the present value of 200, and then we were to multiply that times the rate that we've decided is 10%, so times 10%, then after 1 year, the increase would be equal to 200 times 10%, or 20, and therefore the amount after year 1, we'll call it amount after year 1, will be the original 200 plus the 20. So then if we were to multiply that times the rate, the 10%, we're going to say that we'll have the 220 times 10%, which is now 22, which is our increase for year 2. And then we're going to say this is the 200 plus the 22. That gives us our 242. And that's the amount after a year. Let's say the amount after year 2. And so that's one way we can kind of basically say, okay, well, let's work it the other way and just give us a double check on this. If we have the 200 present value, and then we were to take our 10% for 2 time periods, 10%, $20, 220, that times 10%, $22, plus the 220 gives us the 242. And that's one way we can kind of check our numbers and kind of make this make sense in our minds. As we use the tables, as we use the Excel calculation, you'll note that we're kind of dependent on the Excel calculation. And we want to basically make sure that we can at least think in our mind and see if Excel gives us something funny, something goes wrong. We can say, that doesn't make sense, and we can kind of double check it in our minds. So the tools are great. We don't want to be completely reliant on the tools, however. Now we'll take a look at 2 other questions we could be asked. They're less common, but they could be asked and they could be useful within practice as well. Note, we're usually looking for the present value. So if we had some future value, some 242 in this case, and we wanted to bring it back to today's dollars, we use present value. But it could be the case that we know the present value, but we don't know the rate, however, and therefore we have one missing variable, and we could find the rate if we know the formula. We could use that, we could fix this problem by using the formula and plugging this in, solving for the missing factor. Or we could use Excel and use different type of Excel functions, but then we have to memorize different types of Excel functions. The main one, of course, is the present value. So that's the one you really want to know. And then once you have that, we could also use another tool which is really nice to know about, and that's going to be the goal seek tool. So it's just like you can think of it as an algebraic equation. If we know everything in the equation except for one factor, and everything's connected within Excel, we could tell Excel, hey, figure out what needs to happen in this one cell. And so let's use this method to figure out the rate given everything else that we know. So in other words, we know how to do a formula here. I know the present value formula. We know what it needs to be. We know that it needs to be 200. But I want to put a formula in here and use this cell and then make this rate, make Excel do whatever it needs to do to make this cell 200. So let me demonstrate how this would work. We're going to say, all right, I don't know what the rate is. I need to put a formula in here so that it gets to be 200 with the use of some rate. So let's say I just pick a rate, let's say 5%. So I say, all right, 5% is the rate. I don't know, I'm just picking a rate out of nowhere. I have no idea if that's the rate. Now we'll enter our present value formula here, and we're going to come up with an answer. We know it should be 200, but it won't be because I don't know what this rate is. I just picked a rate so that we can enter the present value formula. So I'm going to say, all right, here's negative present value, PV, and we're going to say the rate is that 5%. I know that's wrong, but I'm just going to use it for now just to get a number, comma, and then we're going to say the number of periods is 2, comma, payments is 0, comma, and then the future value is this 242. Now when we select enter, we know it should be 200. It's not going to be because I don't know what this rate is. I just picked one out of nowhere. So it's at 220. I need it to be 200. So what we could do now is we could start going, well, it's at 220. What if I made this rate 6%? Now it's at 2. Now if I make it 7%, now it's here, right? 8%, and we can go through this process. Or we can let Excel do that process, right? If I put it back to like 2% and say, all right, now Excel, I want Excel to just do what I just did right there. Just test every number until you find the one that makes this cell 200. They're all connected. You can imagine some type of equation that's connecting these two. Excel, is there any number that you can make this be so that that number becomes 200, just like an algebraic equation without us needing to do the math on it? To do that, we're going to go up top to the data, and then we're going to go over to the forecast group. we're looking for the what if analysis. What if analysis, we want to pick up goal seek. So goal seek is the one, useful tool. And so it's going to give us this little dialog box. We're going to say set cell. That means this cell. We want to set this cell. We want to set that cell to be an absolute value because we know what the answer is. It's 200. We want that to be 200. And we want it to do that by changing this cell. So that's what we want. Now, so let's go through this again. We want a set cell, meaning I want this cell, which is B33, to be $200. I want you to do that by doing whatever you have to do to make this percentage cell, whatever it needs to be, to make that 200. And because these cells are connected, the system should be able to do that. It'll just try every number until it finds the one that fits. So we're going to say, all right, do that. And then it says 10%, and that's the one. So that's one way that you can work into the interest rate. Now, again, it's a little bit backwards because, of course, we knew this number, the formula is down here to figure out the interest rate up top. Okay, so we could do the same thing if we didn't know the periods. Same kind of thing. We'd say, okay, I know the present value needs to be 200. I don't know the periods up top. So if that was the case, well, I can say, well, I can guess a number of periods. What if I said, maybe, I don't know, I have no idea, I'm going to say like 10 periods. And then we're going to say the present value down here, I know it's supposed to be 200, but I'm going to put the formula for the present value in and then use goal seek to adjust this 10. So I'm going to use the formula just to get a number. It's going to be negative present value, double click the present value, the rate, comma, number of periods is 10, comma, the payment is going to be 0, comma, and the future value is going to be the 242 and enter. Now, again, I know it should be 200. It's not. So, and I want to change this cell. This is what I don't know. I don't know the periods. So I could say, well, what if it was 8 periods? That's closer. What if it was 7 periods? That's closer. What if it was 6 periods? But I can let Excel do that until this gets down to the 200 amount. So we're going to say, all right, let's go to the data. Let's go to the forecasts and what if analysis. And then we want to goal seek. It doesn't really matter where your cell is, where your cursor is here, because this isn't a formula. We're going to tell Excel what to do all in this data box. So although this cell is highlighted, it doesn't really matter. So we're going to set, we want to set this cell to be 200. And we want to do it this time by changing the periods. So we want to say, hey, change this one to whatever number it needs to be to make that cell 200. Do whatever you got to do to this one. They're all connected. There's got to be some answer. So find that, please. And so we're going to say, okay. And then it does what it got. It goes down to 2. And that's the one. So those are a couple useful tools within Excel. If you do that, then, of course, you can work any kind of problem where you have one unknown, just like you would in a formula. We could do, of course, the same thing here by entering the unknown into the function. But then we got to do the algebraic equation to do that. So we could do that in Excel, and that's a little bit easier than knowing all the functions in Excel too. You could start going, well, I need to memorize the present value function, and then I need to memorize how to find the number of periods formula in Excel. But if you just know the primary one, present value, future value, those being primary, then you'll be able to understand the annuity and the present value of one, and then you can figure out the related factors to it if you have different unknowns other than the present value.